let's get another perspective on all of this. Stocks are, as we said, trading lower as investors price in recent earnings results and commentary from Fed Chair Powell. He acknowledged in a speech today the resiliency of the U.S. economy and says the committee will proceed carefully with its decisions on monetary policy. He also said of the Fed's inflation fight that maybe we just need to get more time.
It may just be that rates haven't been high enough for long enough. And again, it's all happening in a context of very strong demand.
And Powell's comments come, as we've been talking about, as the 10-year yield nears 5%. For more on the Fed and the recent moves in the bond market, we turn to Kevin Nicholson, RiverFront Investment Group Global Fixed Income CIO. Woo, it's quite a day for you, Kevin, listening to these comments, watching the action in the bond market. First of all, what is your reaction to Powell's speech? Is it hawkish? Is it dovish? What, was there not a clear message in there at all?
Julie, there wasn't a clear message because he hedged his bets at every turn. However, my reaction to his speech was I really didn't have a reaction because seeing how strong the economy has been, I had expected for the Fed to raise rates once again this year before actually pausing and keeping rates higher for longer. So I think that this was all in preparation in preparing the markets for what is to come.
And so, Kevin, I think a lot of investors are with you. They see higher for longer now. But when do you think, I'm just interested, Kevin, when do you think the Fed could actually start thinking about cutting? Is that a 2024 dynamic?
Josh, had you asked me this a couple weeks ago, I would have said probably at the end of third quarter of 2024. However, seeing the strength of the economic numbers that have been coming out, it really leads me to believe that the Fed is not going to cut rates at all in 2024. And it won't be until 2025 that we actually start seeing them cut rates.
Kevin, earlier today, I had the chance to talk to Mohamed El-Arian, Chief Economic Advisor at Allianz, of course, President of Queens College as well. And he talked about the sort of unstable footing that we're on right now. I want to play for you what he said and get your reaction.
There's a fear, and I hope it's just a fear, that this could break something. And it's important because we have no anchors. Fed policy is no longer an anchor. Fed policy is too backward looking, is too data dependent. So there isn't clarity on where we're going to be when. And the economy is no longer an anchor. So this is a really hard time for the bond market. And we need stability. We desperately need stability.
So, Kevin, listening to that and that lack of anchor here for the markets, how, as a market participant, how do you even navigate that? And what are the implications for the economy?
I think you have to navigate it very carefully. I think one of the big things that was coming across in that comment was that, in the past, the Fed would have seen the reaction function react a lot quicker to a 500 basis point rate increase. This time around, that has not happened. And the reason for that, I believe, is because the biggest asset that anyone will hold is their mortgage on their home. And most people refinance or locked in at very low rates. So the rate increases haven't impacted the consumer nearly to the same degree they would have in 2007 when folks had a lot of adjustable rate mortgages. Very few individuals in society now have adjustable rate mortgages, so you're not getting the same impact. And so I think that is what is making investors a little uneasy because they don't know how far the Fed actually is going to have to go to actually get the result that they are searching for. And that result is to actually slow the economy down without breaking something. And, 500 basis points is a lot. And I think what the market is concerned about now is that, does that mean that we may have another 100 basis points to go? And if so, what will that do to the economy and the impact of what it's going to do to housing and what it is going to do with just borrowing in general going forward?
Kevin, within fixed income, I'm interested where you see opportunity right now. Is it treasuries, corporates, munis, junk? What are you telling clients, Kevin?
So for our clients, one of the things that we've been focused on is trying to leg ourselves back into getting duration into the portfolio. We think that it's at 5%. We think that the long end of the curve is going to anchor around 5%. It may overshoot a little bit, but we think that this is where we're probably going to settle in pretty close to these levels. So for us, it is just gradually adding duration into the portfolio. And there's a lot of money sitting in money markets. And so one of the things that we've been trying to do is, rather than put money in money markets, we want to focus on taking interest rate risk and less credit risk, because we focus our portfolios at this point on the fixed income side mostly with credit, and it has been at the front end of the curve. While you can get some interest rate risk into the portfolio, not having to extend all the way out to the long end at this juncture, in the 2 to 3 year part of the curve, and still get north of 5%. And I think that that's where we're starting to, tell clients that they need to at least start moving towards and start locking in some of these higher rates. And then we'll see if the long end actually anchors and follows our thesis, close to these current levels. And if so, then we will move further out on the curve and get more interest rate risk in the portfolios.
And Kevin, I know that you focus on fixed income, but of course you work in a shop that also does equity, and we're coming off a pretty rough stretch for the 60-40 portfolio. And I'm wondering what you're hearing from your clients and what you're telling your clients, not just on where to position in fixed income, but about asset allocation right now.
Well, one of the things that we've been telling our clients is that it is time for us to really rethink how we're thinking about our portfolios. I know the 60-40s had a rough time the last 2 years, largely because fixed income has been selling off and hasn't been that risk mitigator in the portfolios. But I do think that going forward, you're going to see more folks add more fixed income to their portfolios, and they're going to take less risk with equities. Because right now, what I'm seeing is that bad news is bad news, and good news is terrible news for equities. If we continue to see the strength in the economy, equities are going to be capped to the upside. On the upside. So we need to think about where are we going to get that return from? And, the equity risk premium has disappeared relative to fixed income. A year ago, that equity risk premium was about 180 basis points. Today, it's non-existent. So that is telling us that the asset allocation going forward needs to be leaning more income driven, and you can get that income a multiple ways. It doesn't necessarily have to be in a bond, but you could get it in a bond-like security. You can use covered calls to generate income in the portfolio, but it's going to be things like that are, your traditional equities are going to go down as far as an asset allocation in the portfolio going forward, I believe.
Kevin Nicholson, thank you so much for joining us today, Kevin. That was great.
Thanks, Josh.